Well, higher interest rates have weighed on fintech stocks broadly this year, with growing concerns about consumer credit tightening. Our next guest, though, is initiating coverage on the sector with an overweight rating, saying there's still ample room for strong growth. Let's bring in Mark Palmer, Benchmark Managing Director and Senior Research Analyst, to discuss more. Mark, good to talk to you. Feels a bit like a contrarian play, but how much of this is about just positioning yourself for that rate cutting cycle?
Yes, thank you. Well, frankly, the fintech sector valuations are just out of whack with regard to the growth prospects of a lot of these companies. Now, I say that talking about those firms that aren't directly linked to credit, i.e. the neobanks or the online lenders, who continue to be vulnerable in our view. But if you look beyond that and look at those fintech companies that are actually well positioned to help consumers during a difficult time, and I'm talking about Block with its Cash App as an example, which acts as a bank account substitute at a time when traditional banks are raising the walls for new entrants, lower income consumers. That's value add, and we believe that that's sustainable. Now, we do expect that interest rates are going to be reduced over time. But with the hot CPI number we just saw, I think that's even in question. And there are other companies that we cover. Payoneer is a good example that could benefit from having lower or higher for longer interest rates, insofar as they have a significant amount of cash which is being invested, effectively float, that they are earning on. So I think this is a stock picker's sector, and there are good values to be had.
So let's break down some of those calls. You mentioned Block, certainly one that has scale when you think about their Cash App, Square, and then, of course, the buy now, pay later, Afterpay. What are the big levers that you see? Because you've got a pretty high premium to where it's trading right now in terms of your price target at $89 a share.
I think there are really two things to keep in mind when it comes to Block. One is that this is a company that, like many tech and fintech companies for years, has really just focused on the top line, growing the top line, getting as deep into their total addressable market as they could. In the current market, that just does not work. Investors are looking for profitability. They're looking for sustainability. They're looking for the ability to manage through a downturn, if that's in fact what we would see. And that comes down to whether a company is able to generate profits or not. Block has really pivoted toward a focus on profitability, really for the first time in its history. And the focus in particular on adjusted operating margin, getting that figure into the mid-20s by 2026, I think is going to be an important metric to follow going forward. And as the company makes progress toward that goal, we believe that the valuation of the firm and the stock should become fuller. Now, at the same time, we look at Cash App, which I mentioned earlier, as being a very timely offering in this market. And we think that the Cash App's growth, as measured in volume and ultimately revenue and profitability, is likely to grow apace, again, simply because it's the right product at the right time.
Finally, Mark, since we've got you, I've got to ask you about Bitcoin's moves. I mean, we're back to seeing it around $51,000. How do you make sense of the move, and how much more upside do you think there is right now?
Yes, well, we look at Bitcoin in this case, it's a big part of the Block story. Now, not from an operational standpoint or a fundamental standpoint, because it really doesn't affect the company's operations that much. But the reality is that Block is perceived to be a Bitcoin name. And the correlation between the price of Block and the price of Bitcoin is quite high, over 0.6. Now, what is coming up right now is what's known as the Bitcoin halving. This is when the rewards that are paid to miners are cut in half. This occurs every 4 years. What we have seen historically, there have been 3 halvings in the past, is that the price of Bitcoin tends to rally ahead of the halving and then for another year plus afterward. So we have seen that rally that has followed the historical pattern. There was a boost there because of the SEC's approval of spot Bitcoin ETFs, of course. But if the historical pattern holds, then the price of Bitcoin should continue to rally, and Block should benefit from that relationship.
Okay, we'll be watching it closely. Mark Palmer, Benchmark Managing Director and Senior Research Analyst. Appreciate you stopping by today.
Thank you.